All right, thank you, Jenny. Good afternoon, everyone. Thank you for tuning in. I am David Marusars, Deputy General Counsel for the DLGF, and I'll be your presenter today. Fred Van Dorp, our Budget Division Director, will not be presenting with me, but I want to acknowledge that he did contribute several slides to this presentation. So I just wanted to acknowledge his effort on that. Also, as you see on the slide, both of our email addresses are readily available. So if you have any questions about this webinar, feel free to contact either of us. We'll have further contact information for our department in general at the end of the presentation. Before I begin, I wanted to go over just a brief disclaimer. This presentation and other DLGF materials are not a substitute for the law. We don't intend this to be considered legal advice. This is just an informative presentation. The Indiana Code always controls. In terms of our agenda for this webinar, I will first begin with an introduction to the concept of excess levy appeals. Next, I will briefly overview the various types of appeals for school as well as civil units. Next, I will go over submission procedures and some additional information pertaining to advertisements, deadlines, and templates. And finally, I'll go over a couple of frequently asked questions. So I will say, though, that there's a lot more can be said about excess levy appeals. We can get pretty in depth with it. In the interest of trying to keep this as close to 1 hour as possible, a lot of this is going to be a brief overview, although I will still be covering a lot of material. So with that, I'll just get right underway. To introduce the idea of excess levy appeals, I will sometimes refer back to our April webinar if you have not attended it, or if you have attended, just as a refresher. We had a webinar on the concept of a maximum levy and various adjustments that the state law provides for modifying that levy limit for various units. In general, most units will annually receive an automatic adjustment to their maximum levy based on the MLGQ, or the maximum levy growth quotient. The MLGQ therefore serves as a limitation on the unit's levying power for a given year. There are some exceptions to this, and again, we went over that to some degree in our April webinar. But unrelated but separate from that is for units that meet specific qualifying and statutory criteria or events, they may petition the DLGF as allowed by law for relief from levy limitations, and that's basically what is meant by an excess levy appeal. The idea of an excess levy appeal dates back to the early 70s with the tax reforms initiated by Governor Otis Bowen that not only put the maximum levy into law, but then also created this process. I guess the idea here is that, well, in general, levies could not increase by more than the amount set by the MLGQ. The legislature wanted you recognize that there were some circumstances that warranted having an exception to this limit, and that is what we mean by an excess levy. Over the years, there were some various kinds of relief that served as statutory criteria for getting an excess levy. Some examples you can see are on the slide. They would, for example, be increases in costs to a county attributed to operating a new court or a court, contracting with a volunteer fire department, or providing pensions for public safety officers, or increasing the amount of township assistance. There are some other examples too as well that were introduced but then removed over the years. So by the 2008 property tax reforms, among other changes such as the expansion of the homestead deduction and the tax caps, repeal of the inventory deduction and so on, or repeal the tax and inventory, I should say, and so on, only a handful of excess levy appeals have remained. But the main takeaway with this is that the local unit just can't claim that it needs the money. There is an aspect of where that will come into play, though, later on that I'll mention. several points. But the local unit must first claim a factual scenario identified as statutory criteria that serves as a basis for the excess levy. Stated another way, the unit has to be eligible for an excess levy based on certain statutory requirements. And a significant part of this webinar will be devoted to explaining those requirements, how the DLGF implements them. Now, when you're talking about property taxes or taxation in general, there has to be a balance weighed between taxpayer burden and the ability of local governments to receive funding to continue operations. The maximum levy, by its nature, serves to reduce the taxpayer burden, while at the same time also reducing local funding or the ability of the local unit to generate revenue. And this is not, we're not even contemplating about the tax caps here or any of the other limitations. We're just talking about the maximum levy. Now, the purpose of the excess levy appeal, or an ELA, as I'll sometimes refer to it just as a shorthand, is to give local units relief from those maximum levy limits so that they can continue to generate revenue to fulfill their government responsibilities. Of course, such relief will further increase the burden on taxpayers. Most ELAs will be found in Indiana Code 6-1.1-18.5-12 for civil or non-school units, as it's said on the slide. For school units, the ELA statute is Indiana Code 20-46-8-3. There are some other statutes that pertain to ELAs. Now, I'll reference them at various points in this webinar, but for the most part, while there are some exceptions, excess levies are permanent increases, meaning that they are added onto the upcoming year's max and becomes of that part of that unit's maximum levy going forward. Some appeals, however, are considered temporary, meaning that the excess levy is only allowed for 1 year. Shortfall appeals are a type of temporary appeal, and that is because Indiana law, the statute for shortfall appeals expressly states the excess levy attributable to a shortfall is only good for 1 year, and it cannot be counted as part of the unit's maximum levy after that. Other appeals may also be temporary based on some other circumstance, be it by request of the unit or at the DLGF's discretion, or maybe for some other circumstance or reason. Of course, even if there is an excess levy approved for the unit, at any point, the unit is under no obligation to levy up to its max. So ELAs are approved at the DLGF's discretion. I mentioned earlier that there are some statutory factors that come into play, and I'll be discussing those in greater detail as we move on. But the DLGF also does consider some general factors. On the slide here, there is a link to a memo that we issued back in 2021, which is an annual memo that we released for excess levy appeals that has a list of these factors. There are about 20 or so. I will point out, kind of as an aside, the DLGF will be issuing an updated excess levy appeal memo with updated templates for the pay 2024 budget cycle. We'll be planning on releasing that soon. But going back to this list, there are, like I said, about 20 different factors, but it can be summarized generally into 5 questions that you see on the slide. So first, what is the overall impact on the unit's budget if the ELA is approved or if it's denied? Obviously, if it's approved, the unit will be able to spend more and generate more revenue to spend more. If the appeal is denied, however, what will happen to the unit's ability to continue to provide services? Also, how much will this excess levy raise not only the unit's tax rate, but the rates in the various taxing districts? Since an increase in the tax rate would affect circuit breaker credits, this could happen not only for the unit, but potentially other units in the taxing district as well. Kind of a related point, and this kind of touches on and some of the other questions as well. One of the things we consider too when reviewing appeal and what the impact will be on the unit's budget is what is its cash, or what are the unit's cash balances for the fund specifically, and especially the fund that the unit is seeking the excess levy appeal for. It could be the general fund, it could be some other fund. That's going to be, of course, subject to the maximum levy. Does the unit have a significant operating balance? I mean, what is significant is, of course, open to interpretation. The tendency appears to be, from what we've seen, that units try to keep around 20 to 30% for a lot of their operating expenses. There are some statutory limitations for certain funds, debt service funds, which I know are not subject to the max, but just bear with me as an example. Those funds are by law restricted to 15% of the levy needed to make payments on debt for the following year up to the tax year, if that debt was issued after June of 2014. Fire territory operating funds are limited to 20%. The cash balances are limited to 20% of needed expenses over and above the upcoming year's budget. Now, does the unit have an adequately large cash reserve? This is kind of a question I'm getting at. Does the unit have an adequately large cash reserve that it can tap into if the ELA is denied or modified in a way that it's not, the unit may not necessarily be getting everything it's asking for? Conversely, does the unit have little or no cash reserve? That seems to make an excess levy appeal, the need for it more necessary. And a tangential question is, will the unit apply part or all of the excess levy to the cash reserve? This is something that we tend to discourage because, I mean, excess levy is based on the need in order to continue operations. If the unit is just going to apply that excess levy and impose those taxes to generate revenue that's just going to put away for a rainy day, so to speak, that's not something that we believe is what was intended for an excess levy appeal. Another question is, what are the underlying circumstances of the appeal? A lot of this goes to some of the statutory criteria that I'll get into. For example, was there an annexation? Excuse me. Did the unit's CNAV grow? Did the unit suffer a shortfall in revenue? That sort of thing. Also, will this excess levy be needed for more than 1 year? Remember I said before that an excess levy can be either permanent or temporary. Will the additional need for an excess levy end at a certain point in the future? If so, can the levy go back to its normal level before the excess levy was approved? Of course, adjusted by the MLGQ and other statutory adjustments as the case may be. The tangential point to this is the excess levy itself is also adjusted by the MLGQ if it's added to the unit's max and it's considered permanent, so it's kind of applied over time, sort of because it's added to the max and then it's adjusted by the MLGQ. It's kind of serves as having an inflationary effect on the maximum levy. So that's another point to consider as well. What other revenues are available to the unit? This is kind of self-explanatory. Talked before about cash balances. How much is the unit expected to receive in like local income tax, excise tax, FIT, fees, or other charges? LIT especially is a big one, as most LIT distributions, local income tax, what I mean by LIT, as most LIT distributions are based on a unit's prior levy. Should be noted that an excess levy will have the effect of increasing the unit's LIT distribution relative to the other distributions for the other units in the county. I did already mention the operating balance. It's not a revenue source in and of itself, but it is money that could or would be available to the unit without the excess levy. Similarly, does the unit have a rainy day fund? And if so, what encumbrances, if any, are put on those funds, as that is another available source of money that the unit, I mean, it's kind of the nature of the rainy day fund. It's money that the unit needs sort of under, as the case may arise, to cover needed costs in lieu of an excess levy. Also, was there any opposition or support to the excess levy? This could be from not only from fiscal body members of the public, but also other units of government. The excess levy increases the maximum levy, which is essentially an abstract number, but the taxes imposed from the max and the excess levies are not abstract. So did taxpayers oppose the burden that would be put on them through the excess levy? Likewise, did other units of government, their officials express concern about increased levy, raising the rates for a taxing district, thereby impacting their circuit breaker? Was there any opposition from their officials? Kind of the final question, what's the overall tax impact? This kind of encompasses all of the previous points I made, but all of these questions kind of boil down to one essential question, is that, is the excess levy really necessary? This is actually part of a statutory requirement that I'll reference several times over, is what's the need of the excess levy? And you can't just look at it from the unit's perspective, it also has to be from the taxpayer's perspective, as well as those of other units. Now, I'll mention here, and I'll bring it up again a couple of times, Indiana law forbids increasing a unit's levy to make up for circuit breaker losses. That is Indiana Code 6-1.1-20.6-9.5 subsection B. States that while there's an exception for school operating referendums for purposes of an excess levy appeal, a unit cannot claim it needs the money to make up for property tax cap credits. So if a unit makes a false claim is that we need this excess levy because we want to make up for circuit breaker losses, that's going to lead to a denial, hard stop. That's Indiana law forbids that from happening. So now we'll move on to talk about specific types of excess levy appeals. So there are 7 types, 5 for civil units, 2 for school units. And keep in mind, we're not talking about any other adjustments to the maximum levy allowed by law, whether it's by petition or automatically applied. I referenced the code citations that for the excess levy appeals that we're talking about. So this is what all we're going to cover. Sometimes there'll be some other adjustments, whether it's automatically applied or it's by petition to the DLGF. But even in a lot of those cases, sometimes the legislature passes a law allowing a certain unit, not necessarily a type of unit, but a certain unit to request a levy increase, to which the DLGF doesn't have any discretion for denying it. There's really not much to those types of adjustments anyway, although I will mention the legislature has kind of imposed some additional requirements on those units, those specific units, such as a fiscal plan, public hearing and notice and whatnot, as well as statutory deadlines for submitting the request. So kind of the procedural matters related to those statutes aside, there really is no DLGF discretion on denying those, so there really isn't much more to say about them. I will, however, bring them up again a little bit later on a certain point. So the first type of excess levy appeal I'm going to discuss is when a local unit annexes area, consolidates with another unit of government, or extends its services to additional area. In an appeal of this type, the unit may claim an excess levy is needed based on increased costs over 5 years attributable to any of these phenomena occurring, starting from when the costs attributed to the expansion are first incurred. Now, this first type is really 3 in 1. They're treated slightly differently. There's some nuance to each one of them. So to start with annexations, again, if you attended our maximum levy webinar back in April, we mentioned that state law already adjusts the annexing unit's maximum levy based on increase in CNAP attributed to the annexation up to 15%. This is, again, not considered an excess levy appeal by itself. It's mandated by statute. It's something that the DLGF and the unit itself, for that matter, must account for. I mentioned this adjustment, though, because when there's an excess levy appeal for an annexation, where the unit requests a certain amount based on increased costs to provide services to the annexed area, the DLGF will take this annexation adjustment into account if the municipality submits that excess levy appeal. Specifically, the DLGF will reduce the amount of any approved excess levy, if it's approved, again, by how much the unit is already entitled to by this annexation adjustment. And if the adjustment ends up being more than the requested cost, the excess levy appeal will likely be denied because essentially the unit's going to get everything it's asking for anyway. It's just there's just no need for this additional step of getting the approved appeal. Again, keep in mind this annexation adjustment is mandated by statute. It is automatic. So, for example, assume a unit has a maximum levy of $500. Subsequently, at some point in time, did an annexation, and for that annexation seeks an excess levy appeal of $75 to cover the costs to provide services to the annexed area. For example 1, assume now the unit's pre-annexation CNAV was $1 million, and after annexation went up $100,000. Determining the adjustment factor, the annexation adjustment factor, by dividing the post-annexation CNAV with the pre-annexation CNAV, you come out with an adjustment factor of 1.10. State law limits it to 15% or 1.15, so they're under that. Applying that annexation factor to the municipality's maximum levy, the unit's max levy will be increased by $50. Because the unit is requesting an excess levy that is more than $50, the unit will still be eligible, though still subject to DLGF approval, and it would be offset by $50 by this $50 adjustment. Now change the facts, and the annexation is now $500,000. So the post-annexation CNAV is now $1.5 million. However, the annexation adjustment factor is now 1.15 because, again, by law, the annexation adjustment factor is capped at 15% or 1.15. So applying this adjustment factor to the unit's maximum levy, this results in an automatic adjustment of $75 to the max. This is actually the same amount that the unit requested in its excess levy appeal. So even if approved, this approved excess levy is going to end up being zero because the DLGF is going to discount that anyway, which is practically is a denial. So these slides are meant to illustrate that what the purpose of this excess levy appeal for annexations is to increase the unit's max levy on account of an annexation over and above this automatic increase. Now, in addition to having a qualifying annexation action, the unit must provide some varying information. A common refrain you're going to see with all these appeals, and I alluded to this earlier, is that in addition to the fact scenario for any excess levy appeal, in this case, the unit had an annexation, annexed unincorporated area. The unit must also prove that the excess levy is necessary to continue to perform its government function. Whereas with the statutory criteria like annexation, 3-year growth, shortfall, etc., we call that consider those objective criteria because it's laid out in statute and something that has to be demonstrated. This inquiry is more open-ended, so we think of it more of as a subjective criterion. Does the unit really need the money? Kind of what I alluded to some slides ago. Does the unit really need this excess levy in order to continue to provide services? I'm going to go into a little bit more detail about what is meant by necessary a bit later. But for now, in addition to demonstrating the costs associated with the annexation, the unit must also show it cannot perform its government function. To that end, the unit must provide the DLGF with information showing these costs, including any of the following: description of facts leading to the annexation, and this is going to go toward what kind of services the unit will provide to the annexed area. All ordinances or resolutions related to the annexation. Naturally, we're going to need to show that the annexation happened. All fiscal impact statements related to it. Again, what's the impact on taxpayers? What's the cost of the unit as the result of the annexation? What's the impact on the tax rate and other non-property tax revenue sources? Again, tied back to the fiscal impact statement. Now, some other, as well as some related information, like, what's the impact going to be on the tax base? Expanding a tax base, you would think would increase the CNAV, and if all things being equal, would lower the tax rate. But especially if the excess levy is going to raise the annexing units maximum levy, it won't necessarily lower the tax rate. Also, the unit may receive a greater share of let distributions at the expense of other units, because, like I said before, the levy is the main measure by which you'd figure out the unit's lit distribution. So that's something else we will also need to know. Now, what the unit should not do when submitting an annexation ELA, don't attempt to ignore or waive the annexation adjustment. This is something that is automatically applied by statute. On top of that, don't inflate projected annexation costs just to get around the annexation adjustment. While I said this ELA is kind of meant to provide additional levy for costs over and above that adjustment, projected costs should still be based on actual capital and operating needs and not simply a way to add to the unit's levy beyond the annexation adjustment. And if the adjustment ends up being greater than or equal to the unit's needed cost, it isn't necessary to submit the ELA. Excess levy appeals, as should be apparent by this point, are fact-sensitive inquiries. If a municipality annexes vacant land with plans for future development, the adjustment is going to be relatively small because the added CNAV is just going to be vacant land. Now, at that point, an ELA may be warranted if the municipality can prove its future needs in terms of plan development, expenses for services, etc. If the municipality, on the other hand, annexes significantly developed land, the annexation adjustment is going to be higher and will potentially increase the max levy more. I mean, these are the sorts of factors that should be kept in mind when submitting this type of ELA. One more caveat, and I'm going to move on to consolidation. The DLGF will not approve an ELA for an annexation when the annexation occurred after the assessment date for the tax year for which the unit is requesting the excess levy. Our position on this has been that the excess levy should be borne by those annexed as well as those already residing in the unit. So when an annexation occurs, the CNAV of the annexed area is not attributed to the annexing unit until the assessment date has passed. Therefore, the excess levy must be tied to the CNAV of the annexed area so that the annexed taxpayers should bear some of the burden of that excess levy. What this ultimately means is that an ELA for annexation would be approved 1 year in arrears. We recognize that this does create some timing issues. State law, for example, requires municipalities to provide fire protection as soon as an annexation is effective. Fire protection is a government service, and more often than not, it's the municipality that provides it, although not always. Even with that in mind, the DLGF has tried to weigh the balance in this particular case, balance the respective interests in favor of those taxpayers, especially those who are already residing in the annexing unit. So that's another last point I wanted to make about the annexations. So for consolidations, which is the second subtype under this one kind of broad excess levy appeal type, this refers to any statutory process where 2 or more units transfer, combine, or share powers, duties, functions, or resources under certain state laws. Whereas an annexation is turning unincorporated area into incorporated area. The third type that I'm going to get to shortly is extension of services, which simply expands or creates a service area. Here we're only talking about kind of a combination or a consolidation of services. You would expect to find this arise under either interlocal agreement law 36-1-7 or the Government Modernization Act 36-1.5-3, or just 36-1.5 in general. I mean, that's the entire Government Modernization law. But there could be some other applicable laws as well. I should note that while this ELA type contemplates an increase in levy, the laws I just mentioned also contemplate reducing taxes either through improved efficiencies or to prevent double taxation. So just want to bring that up. Factors we'll consider here are similar to those of annexations. I'm not going to repeat myself. Just know that it's similar to annexations. Again, the unit or units requesting the ELA will need to show that the increase attributed to the consolidation, but then go on to explain why this excess levy is necessary to continue to perform services. Not much more to say here. So for extension of services, unlike the other two, this is going to involve a unit not necessarily expanding its municipal borders or unit borders, or kind of combining with another unit or consolidating services with another unit, This is going to involve a unit either providing new service to an existing geographic area, sometimes even outside of its municipal boundaries, or extending an existing service to a new geographic area. Examples of this may include like when the county has to provide operating expenses or has operating expenses to a new court that is created by the General Assembly, or a township taking on the new service of providing mowing and groundskeeping services to a cemetery previously provided by a non-government entity, or a municipality establishing a new parks department, or even expanding its existing parks department to the unincorporated township, or a library extending its service area into new township areas. Again, the factors are similar to those of annexation and consolidation, and in terms of the information that we ask for. The annexation adjustment isn't normally going to apply here. However, it's fair to say that one of the ways to qualify is for a unit to extend services to a new geographic area. Typically, this means that there's going to be an increase of tax base, at least for the fund where the excess levy is being sought. Like, again, if a municipality is expanding its parks department service area to the unincorporated area, that's going to be an expansion of that tax base for the parks fund. Conversely, if the county is seeking a levy to provide funding for a new court, because the court's jurisdiction is going to essentially be that of the entire county, there's not going to be any additional CNAV tied to the fund from which the county is drawing that fund, making those expenses from, be it the general fund, what have you. Again, the relationship between the excess levy and the CNAV is important because the DLGF takes seriously the ideas that the taxpayers receiving added services funded by the excess levy should bear some of that burden. Now, with this as well, there would have to be some statutory process involved, such as a referendum, the adoption of an ordinance, or an interlocal agreement. Similar to that of an annexation or consolidation, there would have to be some statutory process allowing such actions to take place. So you can see how in these cases, these three subtypes are kind of interchangeable, even though there's some nuance in how they're implemented. Kind of the last thought on this before I move on to 3-year growth appeals. The amount approved for an excess levy may be an average of the increased cost that is spread out over the 5 years that the statute allows the cost to be recovered. And the amount must match or line up closely with any fiscal plan, especially in the case of an annexation, but also could apply to a consolidation or extension of services. So the next type of ELA I'm going to go over is the 3-year growth appeal. This is in the case of a unit that has experienced significant increases in AV relative to the statewide average CNAV growth over the same 3-year period. State law does have a 6-step formula to qualify. This presentation doesn't list the steps for that formula. You can see in the statute citations on the slide. You can see for yourself what that is. In general, eligible units will have to see their CNAV outpace the statewide CNAV in terms of growth over the prior year by at least 2% over a 3-year period. In the past, this was adjusted by adding in the CNAV attributed to the pay 2006 inventory deduction and the pay 2008 supplemental deduction. These adjustments were removed legislatively in 2022. So now all we're looking at is the pure CNAV growth of the unit relative to the statewide CNAV growth over the same 3-year period. As a courtesy, the DLGF calculates the statewide CNAV quotient. You see that on the slide. It makes it available in the excess levy appeal paperwork. For pay 2024 ELAs, the quotient to compare the unit CNAV growth to is 1.0804 or 108.04%. Here we go. Sorry there. So you can see on the slide here an example of a spreadsheet that the DLGF uses to calculate the qualification for a particular unit for this appeal type. The main variable here is going to be the unit CNAV. You can kind of see in the CNAV column. Here, where you see kind of step 3 divided by step 5, that's the result you want to look at. The unit CNAV grew by more than 102%, so it meets the first criteria for the appeal. I will note it does kind of look kind of weird. There's actually, I think there's a kind of typo in the picture here. The percent signs where it says like 1.0767%, 1.0447%, and so on. Those percent signs should not be there. Please read those as 1.0767, just numbers, not as percents. Just to kind of clear up any confusion. Now, if approved, the excess levy is going to be the unit's 3-year growth percent, as you see, at 1.0767, but then we subtract it by the MLGQ for the tax year. So for pay 23, it was 1.05. So we take 1.0767, subtract out 1.05, and you end up with 0.0267. That number is then multiplied by the unit's current year max levy to get to the excess levy that the unit is potentially eligible for. So here's an example of a unit whose CNAV did not grow fast enough to qualify. Now, comment on the adjusted AV column. This originally included the inventory and supplemental deductions I mentioned earlier. Since those were removed by legislation, it's just adjusted AV is pretty much just going to be equal to CNAV. And as you can see here, step 3 divided by step 5, the growth was less than 1.02 or 102%, so the unit doesn't qualify for the appeal. Again, the 3-year growth appeal is also going to have a subjective criterion. The unit must show that it needs the excess levy to continue operating as a government. I will say this is an appeal type that we see this more often than any other appeal type. This is also because, as you may have guessed, based on the prior 2 slides, this is also one where the DLGF tends to not approve everything that the unit may ask for, because it's pretty, the eligibility amount is fairly rigid based on the statutory framework. We just take the that number, the quotient number, subtract out the MLGQ, then multiply it by the max levy, and that's the number you get. So the emergency levy appeal is the next type of ELA. Here, a unit may receive an excess levy on account of a natural disaster, accident, or other unanticipated emergency. The unit must point to a specific and localized event with a quantifiable impact. Again, by law, it has to be a natural disaster, accident, or other unanticipated emergency. The DLGF has not considered any as a qualifying event an economic recession, past fiscal policies, or more recently, the economic or fiscal impacts related to the COVID pandemic. Admittedly, this is one of the least common and least approved DLAs. The next type of excess levy appeal is what we call a correction of error. This should not be confused with a what's called a correction of error for assessment appeals, where a taxpayer may allege that there was some objective mistake in the property assessment or an application of a deduction, exemption, credit, what have you. On the budget side, where we use the term correction of error to refer to where a local unit, there was an error made that resulted in the unit's tax rate, levy, or maximum levy being affected in a prior tax year. This contemplates an objective error, and like with emergency appeals, the DLGF will not consider past policy decisions as an error. Also, an error corrected by an assessment appeal cannot be the basis for the appeal. This is an occasion for a shortfall appeal, which I'll get to shortly. Now, with this appeal, the error must have been made at the local level. The tax court has weighed in on what this term means in the statute, saying in Clark County v. DLGF that it must be an objective error, that is, an error that is not only readily fixable, but is easily observable to someone who did not make it. The court goes on to say that errors in interpreting data or other so-called subjective errors will not qualify. This includes local fiscal decisions regarding a unit's budget or levy, even when data is used to form that decision. Later on, the court ruled in Goshen Public Library v. DLGF, in particular to the correction of error appeal, that where the error is inadvertently recording the wrong number on a proposed budget, that isn't necessarily an objective error for purposes of this ELA. So from these cases, kind of the key question is, can someone who did not make the error notice the error independently and conclude that it was in fact an error? So in this sort of appeal, the unit should point the DLGF to where the error is and how it occurred. And again, the unit must also then show how the excess levy resulting needed to recover from this error is needed to ensure continuation of government operations. So the last type of appeal for civil units is the shortfall appeal. A shortfall occurs when a unit receives less property tax than the certified levy due to erroneous AV estimates or refunds paid on taxpayer appeals. This appeal is designed to allow a unit to levy to make up for the amount of the shortfall. I'm going to note a few things here. First, the difference between the auditor's certified AV and what's in the county abstract does not mean that there was an error in AV. Second, circuit breaker losses aren't considered a shortfall for purposes of this appeal. Think back to what I mentioned earlier. By law, a unit cannot increase its levy to make up for losses due to the tax caps. So the DLGF for this appeal type relies on certain county forms to determine the shortfall, including the certificate of error and certificate of tax refund claims from the county auditor. We will also look at the Form 22, the unit certified budget for the shortfall year, and the list of taxing districts for which the unit resided in that taxing year. Now keep in mind that the shortfall appeal only applies to funds within the maximum levy. So even if a unit realized a shortfall in a debt fund or a CCD fund, for example, because they're not inherently subject to the max levy, they do not qualify. So this slide shows, how the DLGF determines, the shortfall. It is a two-step process. First, we determine the shortfall by fund. This is pretty straightforward arithmetic. First, take the certified levy, subtract from it the actual distribution for the fund, excluding delinquencies. I should mention excluding delinquencies, and subtract out also any circuit breaker credits, because, like I said several times already, the unit cannot justify a shortfall attributed to the tax caps. The result is the shortfall by fund. And then you do that for each fund that the unit claimed a shortfall in. Then the next step is to determine the unit's share of tax shortfall by a taxing district. Now this is a bit more complicated. It shows the unit's share of the errors and refunds as a proportion of the unit's tax rate by the taxing district rate. We then sum up the results for each taxing district. Taking these two results from each step, the DLGF compares the two results, takes the lesser of the actual shortfall and the portion of errors and refunds. The unit must also specify the budget year or years for which the unit is claiming a shortfall, provide corresponding evidence like the documentation I described earlier. The unit is limited to claiming a shortfall occurring within the last 5 years before the most recent budget was adopted. And that is a statutory prescription under 6.1.1, 18.5, 16, subsection A.